In this presentation, we will take a look at a future value calculation with the periods in terms of months rather than years. We're going to have the information up top. We're going to enter that into the blue area down below. We can do this three ways. We can do it with a formula, we can use the tables, or we can use Excel. In any of these three ways, however, we need to be mindful that the fact that we're talking about months in terms of the periods rather than years. When we think about months rather than years, the rate will typically still be given in terms of years, and we're going to have to coincide then the rate to the months. The common way to do that is to adjust the rate from a yearly rate to a monthly rate. So just remember, when you hear a rate, it means per year most of the time unless said otherwise. And therefore, if we have to apply this to something other than years, we're going to have to adjust the rate. And so in this case, of course, if it's 12% per year, it would be 12 divided by 12, or 1% per month. If you're working with a problem that uses tables, they will probably stay away from this kind of problem because we have to have somewhat of an even rate in order to work the tables. In Excel, however, this is not a problem. In practice, we may well have a case where we have interest rates for a monthly type of basis as well. So just keep that in mind. You have to use the same kind of information, but you got to line these two things up. So we're going to say from the table, we'll say the amount is going to be 10,000. And then we'll say from the table, we want the rate of 1% rather than 12%. And then the periods represent 5 months rather than 5 years. And then we can just pick up our number, which will be 1.0510. We can multiply that out, the 10,000 times that amount, and that will give us our future value. Now we can do the same thing with the formulas in Excel. So if we go to Excel, we go to the formulas, and we go to the insert function. One way we could do it, we're looking for the PV. So we want the FV, the future value. We'll select the future value. We'll enter our data. The key point here is the rate is going to be that 12% that will usually be given, but that's per year. And then we need to divide it by 12. That's going to be the key component. Then the number of periods will be 5. We know that it's 5 months, not by the fact that it's distinguished within the periods here, but because that coincides with the rate that we have, which is a monthly rate. And then the number of payments is going to be 0 because this is not an annuity. And then the present value is going to be the 10,000 and OK. So there we have it. If we double click on it, I'm going to put a negative before the F, and that'll flip it to a positive number. If we wanted to type it in Excel, it would look something like this: equals negative to flip the sign, future value brackets. Then we'd have the rate as given here. The rate up top is the B4, 12%, and divided by 12. Key component, dividing it by 12, comma. Then we have the number of periods, which of course is 5. Those represent months now. And then we have the payment is 0. And we have the present value, which is going to be the 10,000. And enter.